ringing gong of the market open this morning, and let's find out how the markets have settled in. Do remember that we had the US futures indicating that it would be a fairly decent start. After those record highs, it's sort of quiet, and I don't think any complaints with this sideways move. Holding on to 22K, by the way, and for the infra pharma. I want to pull up Z Entertainment because I reckon that's doing the heavy lifting in trade within the media basket. Remember, there have been news reports from the Economic Times indicating that the merger talks with Sony are back on the table in a last-ditch attempt, and that stock, no wonder then, is up and away in trade. HDFC Bank as well. Do remember the management talking about how they will not be chasing high-cost deposit flows, will be maintaining their margins. The stock pretty quiet yet again, no surprises there. That's pretty much been the mood for all of last year as well for HDFC Bank. Kotak Mahindra Bank, yes, there have been redesignations as well. KVS Menon as the joint MD. And the whole rejig coming in 1% higher on that stock. What's going on as well with an NBCC? They've bagged orders worth about 369 crore rupees, and that stock up a solid 2.5%. Torrent Power will be investing to develop 4 projects in UP, a sum of close to 2,500 crore rupees. Torrent Power as well has started off in the green. Titagarh Rail is on track to start supplying some devices for the train sets, and that stock in the spotlight. Do remember Deepak Fertilizers, that 15-year LNG contract that they've signed with a Norway-based company. That stock is up and away a solid 9% on a Deepak Fertilizers. Minda Corp as well. Do remember you've got you've got Bela Agarwal selling that stake in the company, MFs being buyers. There was result reaction from CIE. Check in on that one. Margins have expanded, profits kicked in this time versus a loss. So that stock in the spotlight. Whirlpool as well. Remember, with respect to that, the parent cell is selling stake via the block, and that stock is at about 1292. Sula as well, remember, is in the spotlight too, with Verlin Quest selling that entire stake versus via the block deal. Anisha, there was which one did we see that big block deal impact coming in?
Tourism.
Yes, TFCI, Tourism Finance Corp. It was, I think, a 13% block that traded hands, and that stock is up in today's trading session. Of course, we'll get in a little more perspective later on with respect to the buyers and sellers of that deal, but 220 is where it's at. Anything else you're spotting?
Yeah, just a lot of movers within the broader markets. Paytm, that stock continues to be in the upper circuit, so that's in good momentum. On the losing side, MRPL is cooling off. So after that 18% surge yesterday, no wonder that the stock is retracing today. You also have Biocon reacting to that Jefferies note wherein the downgrade has come by. So that stock is down about 3%. Watch out for Patanjali as well. Stock down another 3%, 4% in the trading session. And Coal India, I was actually expecting a reversal today. Hasn't really panned out. So after that 5% dropping yesterday, the stock has opened with another cut of around 2.5%. I thought the brokerages were a bit more positive on the stock, but nonetheless, that for now is in the red. But Z Entertainment gaining ground. Deepak Fertilizers actually now up 9%. So when we started off the day just a couple of minutes ago, it started with a gap of around 5% that has managed to gain ground. And then EID Paris, the other one. NBCC2, as we flagged out, on account of those order wins, etc., is in focus. But time now to take first trades with our chartists.
Absolutely. Naresh and Sony, what are your first trades coming in? Naresh, let's start with you.
So continued like ICICI Bank, 1030 to 1040 should be a good zone to buy. Keeping a stop loss below 1020 and expecting a breakout in the short term.
Sony, what are your first trades then?
It'll be Jubilant Food. I think it has given a good breakout again, heading to above 500. I think Jubilant Food 499 stop loss and 515, 520 targets for the day.
All right, there you have it. Those are the first trades kicking in. Samir Arora joining in on the show right now, founder Helios Capital, to discuss his outlook on the markets and where D Street is headed. And Samir, we've been hitting record highs day after day. Where is it that you're finding value in this market?
Well, broadly, our main job is to, within the market, sort the market among things that we can go long and things we can go short. So on a relative basis, there's always value. For example, I suddenly realized that I am short 16, what we broadly call consumer names, although they may not be literally consumer staple type names, but 16 names in the consumer sector. So what I mean by that is there are so many places which have excessive valuation and some which have reasonable valuation. It's not that you're finding something super cheap. But the whole idea in trying to beat the index is to basically sort the index. And that way, there's many things happening.
You know, I'm, as always, going through your Twitter page because there's always very interesting tweets that you come out with. You found something, you had things to say with respect to Paytm. I just want to know your view. How have you read into how things have unfolded there?
So we owned Paytm before. We bought it, and I think we told you, at least in my offshore fund, I bought it at some 520 rupees a year and a half ago, maybe year and a half ago. And broadly, we kept it, and now we are sticking with it. Simple logic being that this news and all the actions are worth X percent, according to us, say 30% of business for now in the short term. So the price before the news was around 700. So at 500, we'll see what to do.
Okay, let's see where it really ends, but the saga for now continues and continues to be fairly volatile, Paytm. Sameer, hi, this is Anisha joining the conversation. What about private banking names? Because I remember HDFC Bank was something that you still held a positive view on. Post the management
Absolutely.
commentary that we heard, is it more positive incrementally or it's just status quo? And even let's add Kotak to the list and ICICI Bank.
So we own HDFC, State Bank, and ICICI as our top three holdings. And in order, because of performance of State Bank this month, it has become number one. But so broadly, I still say HDFC Bank is number one. So it's like just behind the top holding. But big picture is that yesterday's that 1 hour thing I saw with the Goldman analyst. But broadly, the takeaway from there was that the management or that the company will focus on bottom line. And if the first, if you get deposits and you can use it to pay off loans, that is as good an alternative as trying to give out new loans. I mean, pay off the bonds that HDFC had got. Bottom line being that the strategy is good. I don't think, relatively speaking, they have lost any value. There are two different businesses. I think what they should have done is presented the two separately to show that the bank per se is doing as well as the bank was always doing, and that the HDFC Bank part is doing, say, as well or a little better as what it was always doing. And it is more that when you add the two, the numbers look notionally lower because of the lower margins in the HDFC and the fact that you have to use some of the deposits. So it could have been explained more simply than it was explained. But for people who know it, I don't think anybody in any way took it negatively. And that is why you saw nearly every analyst reinforcing the buy that they had before. Of course, everybody was playing with their existing biases or views before the meeting. But it's more of the same. So it'll take time, but we are not selling anything. It will see now how it on its own has to go back to being number one. Right now, it has become number two because of State Bank of India's outperformance this month.
Absolutely, that outperformance, surely Sameer, is coming in from the PSU pack as well. This is Winnie joining in the conversation. Good morning. I want to talk about the PSU pack, right? You do have a lot of these PSU names as well in the list coming in. We've already seen a very good run-up in the last 1 month when you look at something like an HPCL as well. What's the view now on PSUs? Do you still think they're quite
attractive? So we have
attractive?
quite a few now. We have State Bank, we have Canara Bank, we have HPCL, we have BPCL, we have Bharat Electronics, and maybe we have one or two more. Broadly together, there must be 20% of the portfolio, which is good enough. So here the thing is that on BP and even HP and even BP, we have. The bet is that they are very cheap. So from the point that because the valuations are so low, it also means because of this 30% dividend that all these guys have to pay out, the dividend yield also becomes very high. In the olden days, the P used to look low, but you would never get any real meaningful dividend. And so there was no, sort of benefit of just holding and saying, let's wait for what happens next. Right now, our assumption is that since BPCL there was an attempt to privatize it prior to election. I mean, prime means in this current term, in whenever 2021 was it, or I think, 21, pre the Ukraine war. And it didn't happen for various reasons. There will be definitely an attempt. Because at that time, the attempt was serious, but because of the world's view on what will happen to oil, what is the terminal value, do you want all these ESG-related concern businesses, all those things went away post-Ukraine when everybody realized that you still need coal, you still need oil. and everybody for himself, that there'll be an attempt and that should give another boost to this sector. And also the government, by not cutting prices ahead of elections, which normally was expected, has demonstrated that they are really keeping an arm's length, and maybe to build a case for the prospective buyer, whoever that is, whenever it happens, that see, even in the face of elections, we didn't interfere. So that is the thing for keeping it, other than the fact that it's very cheap and pays a decent dividend, and everything else, not everything else, but many things look expensive. So it is good to hold this. And we already maybe more than doubled in HPCLR return.
I understand that, Samir. It's good to hold and you've already doubled, but do you think it is a sane level to add positions into PSUs?
So what happens for us is that we run a fund. So we are talking about the first buying for the fund at that time. But if today people put money in our fund, more or less we will buy plus minus the same stocks. Maybe once in a while we'll buy new stocks. So in that sense, this idea that it was a good price 2 years ago, but now it is not, this doesn't work when you are running a fund or PMS schemes or mutual funds or even our offshore fund, because new investors come all the time and you have to buy. Otherwise, otherwise you're basically you're effectively buying new stocks. But most of the time, if we are not selling it, we are willing to buy it, because we don't consider that a stock is in such a position, any stock, that I will not sell it for my old customers, but I will not buy it for my new customer. I don't like that kind of logic. Either it is good enough to be bought for the new guys and then it can be held for the old guys, or it goes. So that is why we can say, yes, we will add if you give us money. And please do give us money, and please sign on for SIPs if you have not done it, all of you.
No, we have, if we can say that, Samir, but because we trust your judgment there. So, interesting take as far as the PSUs are concerned. If you can hold it for your old, investors, why not just keep adding for the fresh ones as well? But shifting focus to what's happening in the pharma space as well, do you think there is a bit of a FOMO or missed out feeling on pharma?
Little bit could be, but fortunately we have two pharma stocks. But yes, we could have had more of those. Actually, our pharma analyst does say buy more. But we always feel that, oh my God, what do we sell to buy? And therefore we miss some of these things. Because at the end of the day, if you have $100 in my hedge fund, I can buy a little bit more than 100 also by going beyond 100%. But in most of our products, you have to sell something to buy, and that makes it a little bit more complicated. But yes, even we feel a little bit more we could have had.
You talk about mega trends, digitization, China plus one, geopolitics, etc. If you could just weigh that in with how one should be playing the markets, looking at some of these big trends evolving through the year, which are the sectors and the stocks in specific that could likely benefit from these mega trends?
So the mega trend is only, according to me, one, which is that India was always doing well, but because of having reached a certain size, both in GDP terms and in market cap terms, it is now too big to ignore. Previously, also many guys, maybe in US and otherwise, may have known that the Indian market, which by the way has done very well over last any period, 5, 10, 15, 20, 25 years, but they could afford to be lazy about it because it was maybe a small part of the world, small part of the index and things like that. And so the people who basically do jobs in these companies, rather than take it as their own money and are basically just doing a 9-to-5 job, could have ignored it. Now it has become too big, too visible. And also because most of these investors, or many of these investors, just following trend, landed up in China and put big amounts and have been burnt beyond their wildest imagination, also want to come to India in some sense. I think that is the trend. That trend doesn't mean it has to go one way all along, because the Chinese market has become very cheap. So someday somebody might again play a catch-up trade. Their numbers of travel and plane trips and railway trips in this Chinese New Year have been very, very good. But even after that, their market did not go up. But broadly speaking, people won't completely walk away, but allocating new money that can come to India, and I think it will come. Although the start of the year has not been good for us in terms of FII flows. If you see in Jan and even Feb months to date, I think both the months have been negative. But still, this big macro trend is the trend for which we are all playing.
Absolutely. Samir, I'm going to pick out on a point that you were talking about first is in terms of the consumer side that you don't find quite exciting, right? What is it that you don't find exciting in the consumer space? Which part are you avoiding? And, what is it that you would maybe consider looking at in the
So
consumption
the thing
side?
is that if you say, many people talk about India being expensive as a market, I don't think India is expensive as a market, but Indian consumer sector is expensive as a sector. If you see the financials, they haven't really done much for 2 years. If you see the IT, which we don't own, but they haven't done much for 2 years. What has done well is these consumer guys and obviously these newer things and other sectors like defense and others. But if you look at the big three big themes, the consumer sector all our life used to grow at maybe 15-20% with valuations in maybe late 20s, mid 30s. Then came this era of the last 5 years where people were brainwashed into saying that valuations don't matter, that these are 100-year stories. Now you see most of these guys, they grow at 10-12% or lower, and their valuations are in 50s. That we don't accept. We are willing to buy at 40-50p if you're growing 25-30% per annum for the next few years at least. That is the only thing we in consumer will buy, even if the valuations otherwise are looking high. And that's why we have these Zomato and Varun Beverages and all. In Varun Beverage, by the way, in my offshore fund, I've made 10 times already, but it grows more than 20-25%. That is what I need for having high valuations. So I don't like 50p for 10-12% growth, which is most of the old regular consumer companies that are considered as high quality and great outperformers in the past, but obviously have not done well for 3 years and most probably will not do well for the next few years till they either start growing at higher rates or their valuations puncture.
Okay. What is the next big risk then, Samir? Is that largely going to emanate from the global markets versus any, risks back home?
Nobody knows. That is the whole story of this risk business that nobody knows. Who would have thought one day before Ukraine war, if you had asked me, will Russia attack Ukraine? I would have said no. By the way, I was reading a book. So the US warned Ukraine that Russians are about to attack you. And they said no. So the point is, don't get into that. Nobody knows. All you have to know is being able to react to it well. Maybe, so what we say is beyond a point, we can't preempt these things, but we will react fast if such needed, whether right or wrong. So after the Ukraine war, we reduced or raised cash by about 15-20%. It didn't help because the market didn't fall. But the point is, that is a better way of doing it than to worry about a risk. That suppose we worry about a risk that China is being very aggressive against Taiwan. If it was, these days it is not, let's say, but generally. Now, what to do today? So point is, let's not go there. Broadly, we are okay. Our valuations, if you take out consumer sector, are broadly okay. They haven't gone up in the last two. By the way, in the last 2 years, our market, as in NSE 500, is cumulatively up maybe some 28-27%. So 2 years, 28% is not something which could have raised our valuation suddenly from what they were 2 years ago. It is in few pockets. So that you reduce, short, do whatever, and otherwise play for the bigger themes and hope and bet on India. That's it.
Hope and bet on India, and that's clearly worked very well till now. But before I let you go, Samir, what's your view on metals as a space? I know it's not a easily investable area because of the moving parts that is there, but any bet that you would want to take?
No, we
there?
don't do it. We basically, in 28 years, I've never invested. So that way. And once in a while, we invest. If it is doing really well and we feel paranoid, we might buy one stock and buy 2%. And that normally is enough to stop that rally, which is one reason I buy it. That let me stop it since I've never been able to make money and broadly very few have been able to in that. But we don't like it generally and we don't like it now.
Yeah, don't touch something which is just going to confuse the view coming in. HDFC Bank still looking interesting. A lot of private banking names as well as the public sector names that he holds, and still continues to add position into some of them. But let's also get a view of Vikas Prasad, the portfolio manager, Asia Equities at M&G Investments, as well as Deepika Mundra, the director at M&G Investments in India, and the sectors that they like.
If you look at the move India has had, in absolute terms, terms relative to other markets, people think, well, maybe we can find better value elsewhere. Our view is that that is not the case. I think this is a great time to be investing in India. In fact, over the last 2 years, we have increased our allocation to India by more than any other market, except for Japan and Greater China. Those three have been large allocations for us. We see a lot of opportunities beyond the index. You were just talking about the action is outside the index. We see the same thing. The leaders of yesterday are not the leaders of today. Today's leaders probably won't be the leaders of tomorrow. There's a lot to look at in India, and so we're very excited. I think it's too much fear about valuation, and we'll come back to that, I think. Too much fear about how much things have gone up, and then too much hope that other markets will deliver better returns.
Let's talk about the construct. Now, if I look at India for next 5 years, 10 years, it stands out. I mean, India's story needs no introduction. Everybody knows that, look, this is the place you want to be in. So, because my question is that when you look at the valuation construct, investing is about buying silver, gold at the price of silver. In India, you're buying pretty much gold at the price of gold. So where will the upside come from?
I think the upside comes through time horizon arbitrage, for one. The upside comes through doing a lot of work and having the conviction that if something goes up 20, 30, 50% or goes up 100%, that you hold on, you don't take profits, you don't sell too early. The trick in other markets is buying too early and maybe selling too late. In India, the trick is selling too early. And we've learned that over time. If you look at our portfolio broadly, we have owned the same names for months and quarters and years now. Defense is something that was just on the air. That's something that we have exposure to despite the rally. Two-wheelers and autos, some of the PSUs, we continue to hold these because we think the prospective returns continue to be high. India might be pricey in some lenses, but it's pricey because that's where the growth is. That's where the returns are. That's where the money is. And so that's why we come back to this market again and again.
So Deepika, where do you find value on the table right now? Looking at the run-up, which some of the pockets that Vikas just highlighted, it's already taken place. And there's so much fear and panic around the valuations, the steep run-up in the stock prices already. Where would you say for the next 5 years, you would say that, you know, I'm still willing to pay this price?
Sure. So just to add to what Vikas is saying is to be patient and not to sell too early. So some of those sectors which we think will see some months of disruption, we would still continue to invest in those. These are the cyclical ones, right? Engineering and construction, commercial vehicles, cement. Few months of disruption does not disrupt the long-term story. On the other hand, we think where companies have good assets which can generate cash flows over a very long period of time, difficult to replace assets, so hotels, airports, REITs, so not necessarily all in the benchmark, but good assets which can see strong cash flow potential over the long term. Autos, we already mentioned, that's something where we are still bullish on. Two-wheelers more than four-wheelers. We see multiple themes playing out in that space, whether it is premiumization in terms of consumer choices, transition to electric, and the cyclical recovery, which is still pending since 2019. So these are the few spaces we think we're still bullish on, irrespective of where prices have gone up, and keeping valuations in mind as well.
So Deepika, whether it's two-wheelers or whether it's cyclicals or whether it's defense, you're betting on a lot of recovery in the economy.
Yes.
Some would argue and say that the deep-rooted recovery has already happened. It's no longer a V. The recovery has played out very well in all the sectors. So then why are you still betting on the recovery themes, whether it is infrastructure or whether it is cement or whether it is two-wheelers?
Sure. So each of them have different reasons. Not all of it is the same. If you had to think about construction or cement, that goes sort of hand in hand in some cases. One, India is still building, right? Whether we're seeing railways, roads, airports, any type of infrastructure, you are seeing activity over there on the ground, and you're seeing the government increasingly still allocate more money to those sectors.
Right, let's get a move on then. Let's dive into Deepak Fertilizers, talk a little bit more about their key levers for growth and earnings with Maulik Mehta, the CEO and ED at Deepak Nitrite. Thanks so much for joining in. To begin with, the performance this time around has been backed by volume growth. The advanced intermediary margins have remained subdued. So what is the outlook on each of your segments?
So across the board, the performance has been more driven by the Indian sentiment, more driven by the ability of Indian manufacturing companies to be able to cater to the Indian demand. And in some places, for example, in Deepak Nitrite on a standalone basis, when we are supplying to AgChem majors, the quarter was a little bit muted because their year ends in December. And in the long view, this is by and large expected to remain stable and improve from a relatively low base. And when it comes to the other segments like textiles, dyes, paper, etc., you will see that there is a volume-led improvement sequentially. This is expected to continue, and over a period of time, once supply chains are sorted out a little bit, you will also start to see a consistent improvement in margin.
Sure, Maulik, point taken, but let's talk about the margins a bit more. They have stayed between the 15 to 17% range for the longest time. You are increasing the share of value-added products as well. Does it mean that there is at least a bit of an upside on margins going forward?
Yeah, so this is exactly what I have also alluded to in the past, that what ends up happening is that the standalone business should expect to see a normalized margin, EBITDA margin of about 20%. Now, once our investments, our first tranche of investments gets commissioned, there's both upstream and downstream investment. And that will have on the broader Deepak Nitrite standalone balance sheet a 2% improvement in EBITDA. In Deepak Phenolics, what we will see, as I mentioned earlier, is volume-led expansion. And as we debottleneck, as we go downstream into products such as MIBK, MIBC, you will see a 1 to 2% improvement in EBITDA on that as well. So overall, on a blended basis, you can expect to see in a sustainable market situation, a 2 percentage point improvement in EBITDA, 2 to 3 percentage point in EBITDA.
Now, as per the channel checks with manufacturers and traders in China, some of the popular chemical commodities are like phenol are facing demand that's pretty strong. There's fresh orders as well coming in largely after the Chinese Lunar New Year. Is this demand sustainable?
So to be honest, and I have also highlighted this in the past, it pays to be cautiously optimistic. But in Q4, one should not look at extending the perception which is built in the first 2 months of January and February, because these are also months where you have this Chinese New Lunar Year, and you have the winter season when, generally speaking, there is low demand and supply. So I would hesitate from extrapolating this. Nonetheless, what you are seeing is also something that our team is seeing. However, this is only as of the last 1 week, as the country has slowly started to reopen. Now, I take it in its stride, and as I mentioned earlier, we remain cautiously optimistic moving forward.
Okay, that point is taken, but separately, one of the major acetone players in the world, INEOS, had declared force majeure at one of their plants in Germany, right? Is this an opportunity that you'd like to capitalize?
To be honest, there are a lot of short-term opportunistic situations that do come about our way, including what you mentioned. There are also similarly, you would hear about the extreme cold and cold snap that's taking place in the US, around the US Gulf Coast. So all of these do offer interesting opportunities for arbitrage. And in the meanwhile, we also have to see how the global freight rates are panning out. We take these opportunities as they come, and it certainly improves our balance sheet. But if I was to project moving forward whether this is going to be consistent, no. But at that time, there will be other opportunities that come up. That our goal is to be close to the ground, and our goal is to be tactically able to take advantage of such opportunities.
Right, Maulik. Also in terms of that rupees 9,000 crores MOU that you've signed with the Gujarat government recently, and the MMA and PMMA as well, and Aniline also. So, if it is possible to share some light in terms of around the capacities that you plan to set up, what is your revenue margin expectation from these facilities as well?
Okay. So to start off with regards to the products that you've mentioned are the products which are easy to announce, right? What we have not gone into detailing out are the specialty chemicals that will be invested in and that will be commissioned over the next year, 2 years, because these are all under NDAs, and hence we don't go into further breaking up the kind of capex investments that we're making. Nonetheless, the capacities that we are putting in are world scale: aniline, MMA, and its downstream PMMA, polycarbonates, which require bisphenol A and its upstream phenol and acetone. These are all part of what we're creating as the largest petrochemical complex in the country. And if one is to look at the processes that we are looking at employing to manufacture these, they will become the key building blocks for a lot of downstream investment. Large part of it will be done by Deepak, and some part of it will be done by partners who are strategically aligned with Deepak. So we are creating, in a sense, a hub and spoke model for the Indian chemical industry. We are extremely bullish on India's growing presence in the chemical landscape worldwide. And we don't believe that it is at the expense of other regions like Europe and China. We believe that India moving forward will be the place for cost competitive, safe, and large scale manufacturing of complex chemicals. We aim to be in a pole position with that.
And finally, in your annual report, it was mentioned that you're establishing new chemistry platforms for photochlorination to cater to the diverse needs of India's 5G electronics, EV, etc. What are these new segments?
Okay, so these 2 points are both correct but cross-linked. So when we're talking about photohalogenation and high pressure fluorination, by and large, these will service India's growing ability to supply complex, fine, and specialty chemicals. And there are other investments also that we're making. The applications that you mentioned are linked to material science, and those have certain properties like conductivity, insulation, rigidity, those things, and those go into applications such as 5G, EV boxes, medical devices, etc. So those are what we call material science, meaning polycarbonates, polyurethanes, and fibers. So for example, we will manufacture intermediates for material which will be used for ballistics as well, which will help to protect humans on one hand, and it will also provide with very low weight, high performance, high heat resistance properties for aircraft manufacturing. These are all downstream applications, and we will be manufacturing the key intermediates which will have certain properties that they can impart.
Okay, so before I let you go, I have to ask you this question about FY25 as well. Given the low base and things looking up, should we expect a major uptick in FY25?
I think we can all agree that if we're comparing FY25 with FY24, it's a pretty low base. So I think that most good chemical companies will be able to improve in FY25. I remain confident about that, not just cautious, but I do remain confident because we will also have several capacities, brownfield and greenfield, which will be commissioned over the next 12 months. And those will also add a reasonable amount to our top line as well as bottom.
Okay, thank you so much, Maulik, for joining in with us this morning on ET Now. It's a pleasure having you on the show, as well as understanding in terms of the outlook for the company going forward as well. That is Deepak Night for y'all. As of now, the stock is holding on to gains of 1%. But let's pull up the charts for IRCTC. What has that been doing as well? All these railway stocks have been abuzz as well. Today, IRCTC is managing to hold on to 0.5% of almost gains that we have seen coming in. When you look at it in terms, the company reported their Q3 numbers as well. Overall, saw revenue growth of almost 28%. 22%. Margins have seen a slight bit of a contraction, almost flattish, you could say, in terms of margins of the company. But other than that, Q3 seems like a decent number. But let's bring on one Mr. Sanjay Kumar Jain, Chairman and Managing Director at IRCTC, joining in with us this morning. Thank you so much, Mr. Jain, for joining in with us this morning on ET Now. And let's just start talking with your numbers and about the numbers as well. If you could start by saying that what are the factors actually that have led to the run-up in terms of the revenue growth that you saw this quarter of 22%? What are the growth levers that are there for the company going forward also? How do you see the top line growing?
If you see the results of the Q3 of IRCTC, you will distinctly notice that the growth is in all the segments of the business of IRCTC, including catering and tourism. So all the segments grew very high, and that contributed to the business. And lever we have, you see, if you see the catering business, you see the railway is growing very high, very fast, and number of trains are expected to be run, particularly Vande Bharat, and to cater to this IRCTC provides that platform of catering and ticketing both. Similarly, if you see the Bharat Gaurav trains, this is a new policy made by Government of Ministry of Railways in recent past years. So that is also leading to business of tourism business of IRCTC. We have already tied up with Uttarakhand government to promote Uttarakhand tourist destinations, which will be like operationalizing this year, and many more such discussion is going on with the state government. And Rail Neer, we have enhanced the capacity. We have already added 75,000 liters per day Rail Neer production by adding one plant. By July, we are also going to add capacity of 75,000 liters per day additionally.
Right, morning. So what exactly is the kind of growth rate then that we can expect for FY25?
Numbers we should not discuss and percentage we should not discuss. What we should discuss, what is the potential. So when India is booming, Indian economy is booming, railway is booming, the capex in railway is growing very fast. When DFC is already leaving extra capacity to run passenger trains on Indian railway system. So everything put together, I can see only the growth and growth.
Okay, so can't talk about FY25 in numbers, but can you talk about margins, because they declined this quarter, they were on the weaker side, and has been very volatile, your margin performance. Could you talk to us about what could be a sustainable number going forward?
You see, on a margin of 320 crores last year, the same quarter, we have achieved 394 crore. So though it appears flat, but if you add the revenue side and absolute terms, it is growing very nicely. And what I feel that what is more important for the company today is to make a growth in its all segment, including catering and tourism. That's how we should try to maximize the revenue, which will lead to more profit for the company.
Also, just specifically on Rail Neer, performance was quite weak this time. What do you expect, in terms of the performance going forward? When do you expect a turnaround on this?
If you see through it properly, it is not the negative side. It's rather we have provision for 14.5 crores of against the demand to the railways for previous years. So that's how the margin appears to be on a negative side. But actually, if you see it, it has also given a good margin, good profit to the company.
And what about the food catering segment? Because that had also started being a material contributor to your business. Do you see this segment growing?
You see, food catering, as I told you, the moment the number of trains are added, the volume will grow. And we have already got this new policy on catering, where we will have a contract for 7 long years. So that will also going to give us a good revenue here. And we are tying up, we have already tied up with Zomato, and many such aggregators we are discussing with, and hopefully we will be able to finalize some of the big one, and that will add to our revenue in catering, and certainly absolute terms the profit will also be there.
Yeah, you talked about the policy action on the food and beverage side, but the government has been doing a lot, right, in terms of policy for railways as a whole. There's Vande Bharat, there's that entire spiritual tourism packages which have been coming up. What kind of contribution do you expect for your business from this? What kind of impact do you foresee?
You see, who doesn't want to go to spiritual places in India? All the foreigners, they are also trying. You will be happy to note that Maharaja's Express, which bring inbound traffic, foreign exchange to India, that is also booming. So including you and me, all will try to go and will provide that platform for the masses.
And also, just want to understand a bit more in terms of what are the plans of the company in terms of investment in technology? Any plans specifically on the fintech side?
You see, we have already incorporated a payment gateway, payment aggregator business, a subsidy we have incorporated. Certainly, we are going to, both for our e-ticketing business and for this new company, will invest, but the thing is under discussion only at the moment.
Appreciate your time. That's the viewpoint coming in from the management of IRCTC. All right, let's move right on then. Clearly, the Modi guarantee is acting as a major fillip for the PSU pack. The stocks are on track, scaling meteoric highs, be it rail, banking, infra, power. So where is it that you should be focusing? We've spoken to a lot of market men, and they've been talking about how the change in governance structures is going to be a huge positive for the sector as a whole. Let's hear out their views from a stock market standpoint.
We have been talking about value as a thesis, and obviously PSU qualify as a value thesis right from September 2021. So it'll not be, we were relatively, as compared to somebody looking at the top, we are very early in identifying that inflection point, and I've been very bullish for last more than 2 years now in this space. So but we remain very constructive. If you look at the larger picture, we are looking for the PSUs, okay? Neither we get too complacent about the move which we happened very recently, nor we get too tense about what happened in last 2 or 3 trading sessions.
Within the PSU, so we've been invested, in PSU stocks, especially PSU banks. We own BHL, we own HAL. So I think we participated, and we really don't look at anything as a PSU or non-PSU. We look at wherever there's a transformation happening, especially, we take care, and we like where there's a governance is in place, a business model is in place and valuations are in place. Our biggest call has been that this bridging of the gap will create biggest value, and still we don't find there's a huge, still there's a lot of value on the table. If you look at in more,
I think there is a significant amount of froth in the public sector enterprise system. There might be some leaders which are still reasonably priced, but I think by and large it is my opinion that the public sector enterprise as a whole is quite expensive as a stock universe.
People thought that coal-based or thermal is going out of fashion, and those are the stocks that have done the best. Coal India is a case in point. BHEL has produced loss after loss after loss, but because of the future being what it is, it's trading at multi-year highs. NTPC has done brilliantly. So if you just take, without recommending a stock or two, if you just take some of the PSUs which have been laggards in the past, but efficiency will come when inefficiencies get dropped off. And I think that's the way people are seeing the sales of the world, BHELs, OMCs, etc., where going forward, inefficiencies are being eliminated, capex is coming in, and the CEOs and the management and the board are being held more accountable for profits.
All right, let's move right on then. And hospitality clearly has been the cynosure of all eyes, with domestic tourism making leaps and bounds. So here to discuss that, as well as earnings, new signings of properties, international expansion forays, is none other than Patanjali Keswani, the Chairman Managing Director at Lemon Tree Hotels. Thank you so much for taking time out. Finally, we've managed to pin you down and get you on air. So good to have you. There's so much to discuss, but why don't we talk a little bit about the numbers and your, financials a little more in detail. Operational performance, that's been a little bit weak in the quarter gone by, at least. There was a higher renovation expense and the deflationary impact of Aurika Mumbai. So can we assume, Mr. Keswani, that the upcoming quarters, your margins will stabilize?
Good morning, Avan. Yes, you can absolutely assume it because, see, you open a very large hotel, which is roughly 13% of the total owned inventory. Naturally, when you open it in the first, initial period, it is not stable. So it has got expenses, but it does not have revenue. Revenue catches up. And unlike, say, an aircraft, a hotel doesn't fill up instantly. It normally takes, depending on the market, the size of the inventory, it takes a certain amount of time before it hits cash break even. And interestingly, our hotel hit cash break even in the first quarter, but there was a big impact of interest and depreciation, roughly 20 crores every quarter. And that's what really affected from a P&L perspective, it affected our occupancy and our EBITDA margins. But that is not going to be the case from this quarter onwards.
You said that it takes time for a property to kind of come up the curve. What's the status with Aurika in terms of occupancy and the revenue contribution? And overall for the business, what kind of occupancy levels are you envisaging for the next 6 to 9 months?
Or in general, or are we talking specific? Well, overall, I think occupancies are picking up. See, we are in the midst of what I would call a structural change in hotel consumption. Over the next 3 years, I expect a very large number of customers, a very large number of people in the Indian population to start, as their income improves and increases with the increase in the GDP in our country, then very large numbers of people move into what we call the consuming population for hotel rooms. So I'll give you an example. The total number of consumers of hotel rooms in India would be less than 5 million households. Literally, branded hotel rooms. Now, that is likely to grow when the GDP grows by about 40% in the next, say, 5 years. This consuming population will grow from 5 million to, say, 30 million. Okay, and that is the real structural change in consumption that we are looking forward to. So it's not cyclical. I hear everybody, analysts, commentators talk about cyclicality. Yes, of course, there is cyclicality in this business, but what I think people are missing out on is the structural shift in demand that will start playing out. And that is why I suspect that the next certainly the next 5 years, there will be literally every half year compared to the previous half year, because we are cyclical in H1 and H2, there will be this big increase in consumers, domestic consumers for hotel rooms. So yes, this following half year should be better than the previous year, and this will continue indefinitely.
Mr. Keswani, yes, there is a structural change. Consumers will increase. But, specifically, I think I just want to put down a point in terms of Aurika. What is it in terms of the occupancy rate that one could expect? You're saying better, but what would that percent be? What would that rate be?
So in the first quarter, we did, when we opened it, we did between 35 and 40%. This quarter, we will do, I think, over 60%. And when it stabilizes, because it is the largest hotel in India, so it's nearly 700 rooms, so it takes a little more time to stabilize. I expect that, for example, in FY26, it will do over 80%, because that's what our other hotels in Bombay are doing. We have 3 other hotels. And it will cross 300 crores in revenue and about 200 crores of EBITDA.
Now, given that, you have your focus now is going to be on strengthening the balance sheet and reducing the overall debt, can you take us through what exactly those metrics are going to be like?
Yeah, so we basically deployed or operationalized about 3,000 crores of investment 1 year before COVID and now roughly 2 years after COVID. So these were the new hotels that we opened, which obviously did not earn the kind of money, returns that they would once it stabilized. So in this process, our total debt peaked at will peak. I mean, it is currently at peak. It's about 1,900 to 1,950 crores. And if you take our debt, I really look at debt to EBITDA. Our debt to EBITDA was about 3.6, 3.7. Now is. And next year, it will be under 2.5. And finally, debt to EBITDA in the third year will be in FY26 will be under 1.5. So effectively, what I'm saying is that by FY27 or latest FY28, we will be debt free. So we will obviously generate enough cash to write off this 2,000 crores of debt in the next 4 years.
Okay, and
at most.
Okay, point taken. But I also wanted your sense regarding the business travel part of things, because what we hear from IT companies and a lot of other companies is that there is a bit of a challenge when it comes to the discretionary spends and travel spends, etc. Is that impacting operations in your business travel regions?
Yes, it is, because in 3 cities we have large inventories which are where the IT sector is a significant customer for us. So like in Bangalore, in Whitefield, we have 2 hotels which have about, I think, 350 rooms. In Pune, I think we have 4 hotels or 3 hotels which have about 400 rooms. And in Hyderabad, we have, I think, about 4 hotels which have about 700 rooms. So these are the 3 markets where IT is a significant contributor to our hotel rooms. What I find interestingly is that in Hyderabad, it has not, in spite of the fact that one segment has reduced, there have been other segments that have more than compensated. In Pune, somewhat similar, but Bangalore, where we have also in Electronic City side, we have another 300 plus rooms. Those markets have not yet recovered. But I am told by my people in sales that this will not be the case from this coming year onward. So it has been like a 1 year impact.
Mr. Keswani, also, what is the shift that is coming in? Earlier you were on that asset-heavy model. Now you're focusing more in terms of management contracts as well. So when do you expect that to hit that 70% inventory for management contracts? How will that actually translate into your earnings growth?
Oh, it'll be a significant contributor. So two metrics you should keep in mind. That for every, so being asset-heavy means you take the financial risk, and obviously you get the upside. But when you manage hotels, typically for every 6 or 7 hotels you manage, the fees that you get are equivalent to 1 hotel. So think of it this way. If I manage 6 hotels, it is like owning 1 hotel with no risk, because that is the percentage of fees I get, which is typically 1/6 of the EBITDA. Now, if I look from what we have publicly stated, we currently have about 100 hotels operational with about 10,000 rooms. 6,000 rooms are owned by us and 4,000 rooms are managed. So those 4,000 rooms really is like owning, say, 700 rooms. So really, that is how you should look at it. Now, what I said was that we have about, I think, about nearly 4,000 rooms which are signed up for management, but those hotels are not yet ready. So they will get ready. They will be added into our operational inventory in the next 2 to 3 years. Now, every quarter, we typically sign, anywhere from 500 to 1,000 rooms. So if I just go by those trends, my expectation is that in the next 3.5 years, we should hit 20,000 rooms, of which 6,000 will continue to be owned by us, and the remaining 14 will be managed. Now, those 14,000 that are managed will give us earnings, which are the equivalent of, say, 1/6, which is like 2,500 rooms. So really at that point, roughly, let me put it this way, roughly 2/3 of my EBITDA will then be owned hotels and 1/3 of the EBITDA will be from the managed portfolio. Although in terms of control, in terms of inventory, it will be the reverse. So we will have 2/3 managed inventory, 1/3 owned, but the EBITDA contributions will be exactly the opposite.
Okay, got to know. So that'll really help overall boosting your numbers. And you're also looking to operate and manage hotels in New York, London, Singapore, Hong Kong. What are the international plans?
So really, if you look at India pre-COVID, about 26 million Indians traveled overseas. And this is a number which I expect will continue to grow with, as I said earlier, the growth in GDP per household at the consuming levels, which is typically, I see three segments, which segments earn, say, $10,000 to $35,000 per household, which segments earn 35 to 100 and over $100,000. So these are really three distinct categories where there is aspiration to consume branded hotel rooms. So the same population also travels abroad. So my view is very simple. Wherever Indian consumers of hotel rooms travel internationally in significant numbers, obviously we would like to have a brand presence there. But we don't intend to deploy capital. We intend to simply manage hotels in those cities and countries. So right now, we are going to be opening a very large number of hotels in Nepal in the next 2 years. I think 4 or 5. Okay. We have a hotel in Dubai. We have a hotel now in Bhutan. And my expectation is over the next 3 to 4 years, some of the cities you mentioned, we will be managing hotels. We will flag hotels in those cities.
Keeping a close watch on that, Mr. Keswani, but that is international. But I just want to understand one thing in domestic travel that's really picked up pace is, pilgrim tourism or religious tourism that we say. Anything specific that you would look at in terms of either management contract side or, opening up hotels in that front over there in those cities?
So we are present in multiple locations where pilgrimages occur. But here is what I was trying to understand, what is this segment and what is the spending capacity of this segment. So I read this very interesting article that last year, the average spend per pilgrim and family in religious destinations was only 2,700 rupees a day, including stay, meals, and travel. So that is not a price point where I suspect branded hotels can make money, because even the cheapest branded hotel would be in the mid 3,000s. So my view is pilgrimages, and therefore the associated tourism will be a very large sector, but it will still take some time for consumption expenditure to actually reach a point where there will be demand for, say, 3 or 4 or 5-star hotels. Until that happens, I would prefer to wait and watch. And when I am pretty sure that there is such demand, then we may look at expanding in that segment. So if somebody comes to us, and there are people who have come to us, obviously, to manage their hotels, of course, we are absolutely more than willing. But the price point and our ability to deliver results is something that I think will still take a little time.
Okay, Mr. Keswani, thank you so much for joining in with us, giving us your time on ET Now. Hope to see you more often on the channel as well. Thank you so much for that. That's the management of Lemon Tree Hotels joining in with us, talking about how consumers are changing in terms of travel, tourism, as well as the boost that we are seeing in tourism as well. But let's talk about the debutant on the T Street today. We have Vibor Steel Tubes that listed on the exchanges. A very strong listing that has come in terms of the pricing that we have seen coming in. As of now, yes, 192% uptake, but listed at a premium of 181% from the listing price that they had as well. So yes, the company is seeing a very, very good listing. That's seen a good subscription coming in, very, very strong subscription that came in for Vibor Steel Tubes as well. And as of now, a bumper listing on the T Street. That's Vibor Steel Tubes for you want to watch out for. But on that note, markets flat is what we could call it. Nothing exciting happening on that front. But let's slip into a short break. We'll be back with more after the break.